Hey everyone, welcome back to Corporate Decoder, the place where we dig through corporate filings so you don't have to. And today we are diving into the world of multi-asset allocation funds, where things can get a bit, well, diversified, almost too diversified. If you catch my drift, we'll talk about that at the end. Today we are looking at the DWS DWS Asset Allocation Trust, and we'll check their semi-annual report to shareholders. So what's inside? We're talking about how these funds invest, what it costs you to be invested, and what the key numbers are. Before we start, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below. Come join us. Right off the bat, this is a semi-annual report, meaning it covers 6 months, specifically September 1, 2024 to February 28, 25. This isn't the big annual report, but it still has important info. And of course, like every report, you can find more information on their website and by calling them. Nothing unusual so far. Okay, let's dive into the important stuff, costs. This part tells you how much it really costs to have your money in these funds. There's a table that shows costs of a $10,000 investment. For Class A shares, it's around $34 for 6 months, which is 0.68% annualized. Then there is a Class C fund that costs $71 for the same $10,000 investment. The report is quick to point out that these numbers are annualized, meaning they double the cost for the whole year to make it easier to compare. It also has a footnote saying the numbers are with fee waivers. Otherwise, it would be higher, so keep that in mind. Next, we have fund statistics. In this period, the DWS Multi-Asset Conservative Allocation Fund had about $60.9 million in net assets. It has 21 portfolio holdings, meaning its eggs are split across 21 baskets. The portfolio turnover rate is 41%, meaning they are pretty active in managing their assets, though this isn't really high. Total net advisory fees were around $10,000. Nothing too wild here. Let's see where your money is actually going. The report breaks down asset allocation, showing what percentage of the fund is in different types of investments. Our largest allocation is fixed income in exchange-traded funds at 49%. This is followed by equity in exchange-traded funds at 39%. Government and agency obligations is only 1%. It also holds fixed income in bond funds at 7% as well. Then there is a table that breaks down the specific companies of the assets. Accession Bond ETF makes up around 11%, and Vanguard Intermediate Term Corporate Bond ETF makes up about 10%. Etc. Fund is spread out among many assets. Its largest company allocation is X-Tracker's S&P 500 scored, and screened to balance risk by holding both stocks and bonds. The report then gives you some resources if you wish to view additional information about the fund, including the prospectus, quarterly holdings, and financial statements. Nothing unusual here either. It points out how to reduce mail in case you like going paperless. It also notes that fund management may favor an asset category that underperforms other assets, something to keep in mind. The next section focuses on the same fund but a different class, Class C. Most of the information will be the same, so we will focus on notable differences. The first difference is the cost, which as noted is $71 for Class C, compared to Class A with $34 per 6 months for a $10,000 investment. The key fund statistics are the same, as it is the same fund with different shares. The holdings are exactly the same for Class C and A. Next, let's take a look at the Class S shares. For Class S, the costs are only $21 for the same investment. The fund report points out that this would have been higher without waivers as well. Just as before, the asset allocations are the same. The second fund covered in this report is DWS Multi-Asset Moderate Allocation Fund, so let's check it out. Here are some key notes about Class A of DWS Multi-Asset Moderate Allocation Fund, or DMAT. DMAT's more equity focused, whereas DMACAT is more fixed income focused. For the 6 months, it costs $31 for a $10,000 investment. Just as before, this is annualized. The key statistics show 21 million in net assets, much smaller than DMACAT. Portfolio holdings are the same at 21. The advisory fees here are 0. Similar to DMACAT, its top allocation is equity and exchange traded funds at 51%, followed by fixed income ETFs at 25%. So this fund has a bigger focus on the stock market than the bond market. The same fund, Class C. The costs here are $68 per 6 months. Same fund, Class S. Costs are $18 for Class S. The rest of this document covers the actual financial statements of the funds and it goes deep. But let's try to extract what's important so we don't bore you with the details. We can see the investment portfolios with the equity and bond holdings like before. It breaks down the exact shares and values of the ETFs and mutual funds. The statements of assets and liabilities show the total assets and liabilities and break down into net asset value with distributable earnings and paid in capital. We can see that DMACAT has 60.9 million in net assets and DMAMAT has 21 million. This shows the net investment income and expenses. This has net investment income realized and unrealized gain and loss, and the net increase and decrease to funds. DMACAT has a net increase in net assets from operations of 636,000. This shows changes to assets through operations, distributions to shareholders, and sales redemption of fund shares. DMACAT has a decrease to net assets of $3 million, whereas DMACAT has a decrease of about $380,000. The financial highlights gives you things like net asset value, the income and loss from operations, and total return. It also gives you ratios and supplemental data, but let's try to simplify it. Okay, the thing most people care about, returns, though these are not annualized. DWS Multi-Asset Conservative Allocation Fund total return is 0.99%. DWS Multi-Asset, keep in mind that this only covers 6 months of returns. The other sections of this report cover things like fees paid to fund directors and also the basis for approving the advisory contract. However, that is pretty boilerplate, so let's move on. The report also notes there were no changes to the procedures by which shareholders may recommend nominees to the fund's board. It states that the financial and executive officers believe that the controls and procedures are effective and that there have been no material changes to internal controls. Towards the end of the report, there is a discussion on electing trustees to the board of directors. Finally, there is a statement about how the advisory agreement was approved by the board a ton. So what does this all mean? Here's my take. Both of these funds invest in a wide range of assets and have an investment management agreement to keep them running aft. These multi-asset funds claim that they have great benefits because they're well balanced and diverse. What they don't say is that with too much diversification, it's likely to perform like the index while collecting fees to big assets that are correlated. To sum it up, these aren't terrible funds, but they aren't particularly amazing either. The fees are decent, the performance is alright, but you really have to wonder if all this diversification is just too much. Personally, I feel a bit concerned. I'd rather have fewer, more high conviction bets instead of being spread out so thin like butter on a toast. Alright, that's our breakdown of the DWS Multi-Asset Fund's semi-annual report, the period ending in February. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description, and I'll see you in the next one.